Good afternoon, everybody, and welcome to today's session, ERP Controls, what are they and why they matter? For those of you who don't know me, my name's Emma and I'm here on the marketing team at SafePass, and I'm delighted to be joined by Deepak Iyer, Risk and Controls expert, and SafePass CEO Adil Khan. So in the light of the FTX story and the general lack of understanding around the complexity of controls, I invited thought leaders Deepak and Adil to share their insight and real-world experiences and discuss with you today why controls matter. But more importantly, we wanted to discuss why organizations are failing. So, you know, if companies are audited by the best audit firms in the world, why are they failing? If they're using best of breed systems, why are they failing? So Deepak has worked with some of the world's largest organizations, including TMF Group, Tesco, and Ocado, assisting them and helping them understand the importance of risk and controls. So Deepak, can you tell us, can you tell yourself and, you know, why have you decided to focus on risk and controls for the past 15 plus years or so?
Sure. Thank you for you know, inviting me to this session, Emma and Adil. So yeah, the first question is about my background. So yeah, overall 22 years of experience, but after 15 years of working in different facets of accounting, including shared services, transformation audit, and investigation and transformation, I realized that prevention is better than cure. When I was doing roles in audit, more often it becomes quite tricky to actually go and put preventive controls in place, or because of the independent nature of the audit function, there is very less opportunity for us to actually go and work on the ground and make things better. So I kind of distanced myself from the third line, which is the internal audit, and started focusing on the second line, which is internal audit, which is risk management. And that's essentially been my area of specialization. So I help companies identify risks and manage risks, both in the enterprise risk world as well as the financial controls world. And in the broad context of what I do, financial information is often held within IT databases, and therefore a part of that database and the security around that database and access becomes included in what I do. So that's broadly my kind of expertise and experience.
Excellent. And you, Adil, you founded SafePass after the collapse of Enron. Is that right?
Yeah. So you know, being in Texas, there was a company in Texas that collapsed, and you know, we had some friends and family that were impacted. And that was 20 years ago, right? More than 20 years ago now. President Bush signed the law here in the U.S. back, Sarbanes-Oxley law, as we call it, back in 2002. So yeah, it's gosh, 20 years have gone by, and it's terrible to see that in 20 years, with all the you know, audit improvements that we brought into the market through the SEC, Security and Exchange Commission in the U.S., and all other regulatory improvements that have been made, auditors that have been, you know, reformed to audit differently to a higher standard, what we call the COSO framework, that companies are still failing. So I think this FTX really hit close to home because you know, it's a startup organization in an environment that is difficult for many to understand. I know it's hard for me to understand how they operate, and so it kind of prompted us to think about, you know, what can we do better moving forward, as we always learn from mistakes and lessons, not just our own but others too. So this certainly created that another inflection point in our drive towards our mission, to help companies reduce risk and improve their businesses. And so we have some exciting information to share with you today, that might help people. Because as I was telling you guys, I mean, most people that get on these calls with us and want to hear about controls are folks that already believe in controls, right? So I think the topic today around complexity is where the challenge I see from our customers. Our customers tend to have really good intentions to implement good controls, but time to time they have findings. Sometimes they even have penalties, and in some rare cases they have disclosure issues, which can create market cap losses and so forth. So that's what our mission that started 20 years ago as a consulting firm, and over the last 5 years as a product company, has kind of led to really focusing in this space.
Great. So let's start off by discussing FTX then. And in this case, our audience here today should realize that what happened at FTX is an exception, right, Deepak?
Yes, I think this is an exceptional situation. I don't think the crypto market is yet regulated the same way as banks or financial institutions are regulated. I think part of the issue that's coming up with FTX is they have kind of, supported some of the Congress parties or some of the political parties in the US to keep some of the regulation at bay. And that's kind of one of the reports that I keep reading. So basically, it's not being regulated the same way as other companies are. And therefore, there is not much of an insight into how, in terms of expectations and in terms of standards that such organizations need to have and maintain. So I think looking at it, I think they have used fairly off-the-shelf products, very QuickBooks and Slack for recording transactions from what I can see and read. They are not the right kind of tools to go to for such a big organization that's dealing with billions in terms of value of transactions. So yeah, I think it's a one-off, and I think it's one of those things that has happened while we waited for the regulation to come in. And people who are investing in crypto and markets which are unregulated yet do unfortunately take the risk of it's a big risk, big profit, if not big loss, and that's essentially the nature of the game. So it's very different to banks or financial institutions or any other forms of investment, which have far more regulation. And like what Adil was saying, there's a lot of SOX and various other regulations and assurance activities around that gives investors the confidence that these companies have the necessary policies, frameworks in place to report the right numbers and for the capital to be deployed safely and for the returns to be generated well. I think this is a one-off case. And it's applicable for all those organizations where it's unregulated, and crypto, I think, is one of them.
You want to share any additional insight there, Adil? Any thoughts?
Yeah, I concur with Deepak, right? So I think most people that are listening to our this webcast will recognize that. I mean, I think the only place I would add a little bit is that I don't want us to sit back and feel comfortable that that the systems that companies that deploy systems that are often audited are significantly better, because my experience has been that even with the best of the systems on the market today, controls, especially ERP controls, which is where I spend most of my time, still a challenge. So in this case, Deepak, I completely agree with you that the risk is unmitigated essentially in this business model right now. There is lack of regulation, as you said, but also the type of investor profile that is willing to play the money is taking risk that's beyond the tolerance level of most of our typical customers, I would say, right? And I think it's been many failures just based on that market. But I think what we really want to use this opportunity is to farm up our approach and our beliefs in good controls, and I think system controls are challenging even with the best of systems, and we'll talk a little bit about that later in the session.
Yep. And I think just to add to that, in terms of their
So why
choice
do
of
you think
systems,
this
one
is
is, of
such?
course, we have talked about regulation not being applicable.
Emma, I think you're.
Sorry, can you hear me?
Yeah, we can hear you, Deepak. I think Emma is frozen. Go ahead, Deepak.
I can hear you, Beth.
Right. No, okay. No, I was just adding to what Adil was saying. I think keeping the regulation aside, if you look at a company of a certain value, the choice of tools that they have made and the nature of the transactions and how they were recorded, what we are reading in the reports clearly shows the huge lack of governance at the top. And it's almost like it's been set up to fail, and the intent, management intent, which is very important there, is kind of being reflected. We still don't know the details of the case. We need to wait for it to emerge. From whatever has come out in public, it shows that there wasn't an intent at all in the first place to basically do this in a proper manner, and that's reflected, and that is why it's an extremely one-off case.
Right.
And I think what we are talking about is the companies which invest a lot of time in choosing the right tools also, unfortunately, at times don't implement them or don't prepare enough to implement them properly. And that is a bit of a concern. I think that is where there is a huge opportunity, and that's where I feel a majority of organizations fall. So that's all I wanted to add.
So why, in your opinion, do you think there's such a big misalignment in approaching risk management holistically? And so, what about the role of systems? Where do they come into play? And, why do you think that organizations are struggling to understand the why of controls?
I think good question, Emma. I think the name risk management itself, I personally am not a fan of the name risk management because it means many things to many people, and also it denotes a kind of a negative view of somebody being a bottleneck, somebody who prevents a specific activity from happening. That's kind of the nature. It could be a risk and opportunity, or there could be different ways in which we can code it. So risk management means different things to different people, number one. Second is risk management also means enterprise risk, which is all about strategic risks for that a company faces, and how do you write that up? How do you present that? How do you challenge the board? And how do you prepare the board to meet those challenges? And how is that finally disclosed in the annual statements? So that's a specific piece of work that's called under the enterprise risk management category. Then you have your financial controls and risks that's for financial reporting, which comes essentially from the audit world and the SOX world, where you're talking about making sure that the accounting transactions are recorded well, they are accurately, and they are disclosed in the right manner. And there is a huge influx of various auditing standards that are applicable there. So that's one. And then you have now the information security aspects of it, which also use the similar wording such as risk and controls. So the words risks and controls mean different things to different people, number one. Second is there is a lot more focus on controls. Well, there are so many people who tend to focus on, say the computer says, this can't happen. They say they put a control in and people are expected to follow a control, but people are not told what the risk is if they don't go ahead and implement a control. So the lack of appreciation of what the risk is. A control is a response to a risk. And a lot of times people go in and the way it's put into various processes and systems is these are a set of rules that you have to do, but people are not often told why this has to be done. So the way in which the subject is taken to the people at different levels of the organization is also a big challenge. So this is the second point. And the third one, which is very important, which I've seen as an emerging risk in the last 5 to 6 years, it's been consistently, I'm observing this, is sometimes I feel the IT general controls seems to be falling in no man's land. to a certain extent because the CISO or this chief technology officer, they work on specific databases and certain infrastructure requirements. And then you have the financial people who talk about the controls within the processes, etc. And there is this small area which is, controls within a specific application and within who can access a specific application. Now, those specific aspects are not immediately, they don't have an owner. They end up as a residual activity and then they seek ownership. In many transformation programs that I've seen, sometimes it's the beneficiaries of the data sets. For example, if you have a database that holds Oracle Fusion, for example, if you have Fusion and it holds all the financial data in it, now the question is who can access this database? What is the security within the database? Those are things that the transformation program initially needs to understand. They need to get information security involved, and the right people have to be involved, and it requires people from security, finance, or internal audit sometimes for guidance, and it also needs risk and controls. All these four people to come in along with the technology experts who are configuring the various systems to make sure that the right setup is done. And that most often does not happen because they take a software, you go and implement it, and then you realize, oh, probably there are so many aspects that have not been taken into account. And that is why I said sometimes it feels in a no man's land, because we wait for a specific transformation program to get completed, and then there is a question on, okay, so who's going to own the security aspects of this specific application that we have implemented? Is it going to be information security, or is it going to be risk and controls? Is it going to sit within finance, etc.? So I think that's the third reason: lack of a clear understanding at the top and responsibilities as a part of the transformation program. Those are the three reasons why I think there is a lot of confusion in the area of risk and controls.
Yeah, those are, Deepak, I agree with those points. I just want to bring maybe some examples that are folks here on the call. Go ahead, Emma. You're cutting out a bit. Yeah, I'll continue. So I'll just add to those a few examples of what I've seen in my travels with 200 customers, enterprise customers.
No, I was going to say, in response to Deepak, what are your thoughts?
Yeah, so Emma, I was just going to add a few examples of where companies can maybe pick up on what we have learned in the market on how to improve that risk management to control alignment. So the first thing in my mind, what I see is most of our large portion of our customers don't have a very formal integrated enterprise risk assessment process. So risk assessment is the process where you actually rate your risk based on likelihood, impact, and other factors, some cases velocity, and there's a whole, books and books written on that, and not everybody has the time or has the responsibility to learn that. But what it does, it basically, I'll give you a practical example. It tells you that you're not going to spend $1,000 to put a control in that protects $100 of petty cash. And we call that a risk-based approach to controls, right? So to pick on Deepak's point, that's what's lacking, I think, that's what creates the beginning of the misalignment, because we don't have good risk assessment processes in place at most organizations. And it's tough to do, right? Because you've got the strategic folks at the top of the organizations that are focused on macro risks about liquidity and market conditions, inflation, recession, all those kinds of things. And then you've got department level folks, business line folks that are about customer retention and product liabilities and cash flow management and those kinds of operational issues, right? So the alignment there breaks down in many cases, and I think there are systems out there that can help you ensure that alignment does not break down. And when that breaks down, what happens is what example that to picking up on what Deepak said is that people start continue to perform controls without understanding now why that control is important and what happens if that control fails. What are the mitigations? So when a control fails, many times it can be catastrophic, because even though someone at the top understands the secondary control, let's say the process owner, or the what you call a compensating control, that level of maturity is not in many organizations. And then it's not the fault of the people that are operating the control. This is not their day job. They're not control expert. I worked with some of the, for example, top universities where I've met some of the smartest people that are solving, cure to cancer and all the biggest world's problems. And they pulled their hair out saying, we don't understand why we're failing our audit, because we believe we have the best controls. We are smart people. We know what the control is. And a lot of times it's the challenge is that what the control somebody designed in a corner office based on a risk assessment that was done someplace else is not aligned with the operating effectiveness of the control that the auditor is testing using the samples. So the answer is that the reactive approach to controls, which is what I just described, or the informal approach, where people think they know controls and they think they know risk, is just not working for most businesses. They're fatigued with audit findings. And it's time really for companies to consider a more integrated approach to risk management, which what means to us is that these different activities like enterprise risk management, risk assessment, control design, and operational of control, and then testing of the control, they all need to be integrated. Now, it's easier said than done because organizations have many systems, many, especially the enterprise customers we focus on, many locations they operate in. So it's not everybody, having a kumbaya moment in a single office and saying, yeah, we'll follow this. It's a continuous improvement process. And what we have found is the answer is to embed the controls in your systems. Because once you can understand the control and design it and align it with your risk, you can embed that in a control so it becomes a habit. It's not an afterthought. It's not something you do at the year end for the auditors. It's just the way you do your business. And that's what we're here to talk about.
But
just to give one more example there.
Go ahead, Deepak.
Sorry, just to add to what Adil was saying, when he talked about embedding, I think that's a root cause. If we give that example, I think the problem becomes a lot clearer. Suppose if they are implementing an ERP system and there is a purchase order that needs to be raised, and there is a certain limit, say, for example, up to £10,000, somebody can approve, and then beyond that, it goes to somebody else for B for approval, and then beyond that, it's person C who needs to approve. If these controls ideally have to be embedded within the enterprise, within the system. If this is not implemented properly, then what happens is then there is a workaround that starts that we need to put in, saying get a pre-approval from the person who is authorized to make that approval, and that is by email. Attach the email to the PO, and then you submit the button. So it's almost you are reverse engineering what the system can do it. It's been configured badly, and the controls have not been embedded. Therefore, you are creating a workaround of asking somebody to take an email approval by and then attaching that approval to this system and then going ahead with the purchase order submission. Now, this is a classic example of when it is not properly implemented, the controls are not properly implemented, it creates a range of workarounds, and the workarounds are the first things that get picked up after a transformation is done, and then it creates a lot of work, because once it's designed and implemented and people have been trained, it is very difficult to go back and update it. It's very costly, time consuming, and there is also this fatigue. People who don't want to do that same training again. So it creates a lot of fatigue as well. And that is a classic example of why it is important to consider controls and risk management before we start, during and before the blueprint phase in a transformation project, and why you need that knowledge to come from program managers, sometimes CTOs, CFOs. That question needs to be asked: do you have the right people in your program, involved in your program of transformation. So that is why it's a joint up integrated activity to make sure that you have all the right people working, doing their roles well, so that the project is delivered to a good design and on time. And I think that's essentially where the internal controls kind of fails in many transformation programs.
Mm-hmm. And that's obviously easier said than done, though. So how can they actually achieve that?
I think it's a collective exercise. I think based on my own experience, the times that I've been brought in to support has rather 3 out of 5 times I've been asked to come in and support once the transformation was over. But the good news is once they realized it, subsequent transformation programs within the same big organization meant they included me in the beginning. So they realized what they had done, and then from the subsequent programs they included me. But that was with one specific client. However, when I look at a number of clients, like I said, 3 out of 5 clients tend to do this as an afterthought. They have either implemented Dynamics or Fusion or SAP, and then they say, okay, now can we have risk and controls embedded to basically into the system, and that's where the problem is. So it's more about awareness, more about education, and making sure that people at the board level understand. And also we need the external audit profession and the internal auditors to play a larger role in explaining that to the program, the board and the program management teams. So that's one of the causes I'm trying to champion using LinkedIn and as many forums as I can to demystify this and explain to them that we need to design it properly.
Yeah. Would you add anything there, Adil?
No, I think that is the reality. Companies get budgets approved from the board to go and transform. Digital transformation is the big topic today for most boards and executives. So we're in the middle of this digital transformation era. And so when these systems are being put in, whether the company is moving to the cloud, their IT infrastructure, their applications, or whatever that is, as Deepak said, the idea of controls somehow gets left behind because people think that they can retrofit the controls in the system, and there's a lot of pressure to get the project done on time. And unfortunately, controls are the first things that get overlooked or pushed out. And companies pay a heavy price because without controls, their processes are failing, right? Either they have bottlenecks. You can also have too many controls, right? You can have bottlenecks you can create where I've seen customers, people are sitting there twiddling their thumbs. They cannot get onboarded for 2 weeks because they have issues with too many controls, redundant controls, from the CISO's organization versus the audit organization versus whatever those systems are, departmental controls. So you're over fatigued, overburdened with control. That's slowing down your business. On the other hand, which is more common, some places you're missing controls. You're not tracking changes that are happening in your ERP system right after go live. That's a common one that I'm seeing a lot, especially in the cloud customers, where you still need support or hypercare from your supplier that helped you implement the software, and they're still in there holding your hand because the software is too complex, taking longer than you expected. Certain processes are not quite streamlined as you had hoped, and so you've got people that shouldn't be entering suppliers and paying suppliers, helping out, quote unquote, but that's creating audit findings left, right, and center, right? So I think that obviously, we live in an ideal world, and sometimes in this side of the aisle, in an ideal world, we would want everybody to design the controls when they design the process. That alignment, we cannot, expect our customers to always abide by because of reality of the business. We understand that, but I think having partners like Deepak and others that can roll up the sleeves. If you call us early on, during the systems implementation or discussions, we can bring in folks like Deepak to the table that have really done this work, right, for many other organizations, and really can help you get the ball started. Even if you're already, if you're already middle of the project, we can still help you save a significant amount of headache, not to mention cost and embarrassment with audit and your executives by accelerating that design workshops and embedding control workshops into the process workshops of your migration, deployment, maintenance of your software.
And if this is implemented well, it reduces a lot of headache. It reduces a lot of audit as well, internal audit that comes up, and it also reduces the number of substantive audits that your external auditor will need to do. So otherwise they will start looking at checking a number of transactions. If they are not able to place reliance on the design of the control, then they have no option but to look at a huge number of transactions to kind of go through to get that kind of comfort level saying, yeah, we are happy with the way the control is working. So this reduces a long-term cost for the organization. That is the reason why I moved from audit into risk management, is a stitch in time. This genuinely saves a lot of headache and cost for companies in the long run. So yeah.
Yeah, and we've talked about software vendors, Oracle, SAP. What about the software vendors?
Yeah, maybe I can take that one because I spent a lot of time on software. Deeper, I'd love to hear your perspective as well from a risk management perspective. But look, I've been in the software industry most of my life. Like many of my colleagues here, SafePass. Many of us worked at Oracle, for example. So I'll pick on Oracle, which I'm comfortable with, and Oracle's a great company, and we love the software they have out there. I've used it, I've implemented it. But I think the challenge is that this software, the ERP idea started back in the 70s, I think, with SAP saying that, coming to market and saying, look, if you could just put all these processes into one big software, so that your procure to pay cycle aligns. As a manufacturing company, that's where SAP started. So your procure to pay cycle aligns with your order to cash cycle, and that links into your financial record to report cycle. You will solve a lot of your bottlenecks, and that was an excellent idea, right? And the whole world has believed in it, and companies now like Workday and Salesforce and many others have come to the market and really build some great software that integrates your entire business. But having said that, these softwares weren't designed by control experts, right? So the control has always been an afterthought, not only among how it's implemented by the companies, but also how the vendors supply the software. I'll pick a very simple example. You can pick any software. You don't have to pick on Oracle. Pick any software for your business. It's not going to come with roles and privileges that align with the policies of your organization. I can assure you, every software that's out there has roles that you can grant out of the box to your purchasing department, where they can create suppliers, pay suppliers, create invoices, pay invoices, and maybe even post journal entries, right? Now, Deepak is probably cringing when I say that, because that's what auditors would do, right? And risk managers would do, because they just can't believe the software does that. I've actually had discussions with some novice buyers of enterprise software where they just didn't even think about that. They can't even fathom that millions of dollars they're spending on buying the software and then millions of dollars implementing software would have some basic flaws like that. So unfortunately, that's the way software was built. And we have been doing rinse and repeats since the last 50 years to implement that same software. It does produce great results, don't get me wrong, in terms of the objective that it was built for back in the 70s, which is it connects all your departments. But guess what it does also? It gives you ability to screw up faster too, right? Because it has no controls. So that's where SafePass kind of, we woke up and said, okay, well, what do we do to solve this problem? For many years, traveling the world, we're scratching our heads that, look, companies are adopting these best softwares in the world. They're hiring the best auditors. They have the best management. They have the best intentions. Why are they failing, right? I'll give you an example of a customer on the East Coast of the US that has lost over $1 billion in market cap overnight. There are many of them that you would know as well. So I'm not kind of picking an extreme example. This happens every day. And the reason that happened is because they had an interface from one of their systems that failed and that used to fail often. And so what they had done was enable their support staff to go in and manually enter those entries. Guess what the interface was? It was journal entries coming from another system. That's a very typical example of an interface. So you buy a big software that does, all your back office, and then you have front office software that is different because you have a special business model, and that feeds into your journal entries on a monthly, weekly, daily, nightly basis, depending on the size of your business and the transactions that are happening. Well, because they were going in there and manually entering those journal entries through the interface failures, they thought they were doing, again, people working late hours. They think they're doing the best thing for their company, making the well-oiled machine run so the CFO can get the financial statements on time. Their auditors, which is one of the big four, I won't disclose which one, refused to sign the financial statement, and they could not file their financial statements with the SEC on time, and they took over $1 billion in market cap, which is probably, this is 10 years ago, so this would be worth probably 10x now, right, where the market is now. So imagine losing that much market capitalization overnight for one simple interface failure. Now, why does that happen? We had a good person doing the, intending to do the right thing. We had a system with provide flexibility to send interfaces. We had reports to see interfaces, but the system does not control the interface, right? So when that interface fails, the auditor says, I don't know what transactions went in and what was there. Did somebody back out a big liability? Did they pick in a big revenue number and to close the quarter? We can't rely on your systems anymore. To Deepak's point, we'll do substantive testing, which will take us 3 extra months because you are so complex. So we won't sign on the financial statements for this quarterly or the annual results. So this can be significantly damaging. I like to talk in real world examples where I've seen these issues. And what SafePass has done is to build a solution that governs all your systems, sits on top of it. So these kinds of mistakes don't happen and you don't lose billions of dollars in market cap and millions of dollars in fraud and other waste that happens every day in organizations.
Have you seen anything like that out there, Deepak?
Yeah, I think spot on. Adil is spot on that. I think for me that interesting point was the software. If you look at the top softwares, they all provide a range of control, options. A company has to choose the option that is relevant and appropriate for them. That is important there on one side. And so let's look at it this way. We've got auditors who are all trained accountants. Their background generally comes from an accounting way. They know how controls work. They know what they should look like, what it should do, what it shouldn't, but they are not IT experts. Then you got engineers who have designed these solutions, and they have given a range of things that a control, how a control can be configured, but they don't know what is right, what's the right level of control, and they shouldn't also. It's for the company to implement. Somewhere in between these two worlds, there is a gap, and it's not implemented properly. So sometimes, for example, if somebody wants to do a bungee jumping, the control could be somebody may put a parachute on them and get them off the cliff. And that's not going to help because that's not the right control for a bungee jumping. You don't put a parachute and get somebody, to experience that. So you need to have the harness. So that's the issue that we have. So you have the software, but you don't have the right people who understand what the right materiality is, what's the right level of control that we need to have while designing and deploying a specific software, and what we need out of this in terms of reporting from an audit point of view, from getting us through that line, what is that we need and what is the right amount of control we need to have. So that design element is missing. And while it's there, for all you know, a lot of the work I do, I have to go back into the system and just enable controls. They are there, but they have just not been activated. It looks very simple, but instead of a workaround, it could be so. It happens so often that we go sit with the technology teams and say, we want this control to be enabled. Why was this not enabled? Oh no, nobody told us about that. Right. And then when the process mapping happens and when the controls are put in, and that's the time when, before it goes into a build state, that's when you design these things. And it often doesn't happen. So I think I will give a huge credit to the softwares. All of them do more.
Oh,
To support, to kind of design and deliver this solution, and that often fails. That's what I've seen.
Mm-hmm. So going back to, why I had the idea of inviting you both here to discuss controls. FTX, we've said, was an exception. It was also a young company. So why in particular are controls critical for, startups and even pre-IPO companies?
yeah, I can take that. I spent, I lived in the Bay Area. I spent a lot of time with startups, venture capital funded startups, including one very famous one that sort of invented social media. And I had the opportunity to work with them in early days when, way before IPO, when they were still, in the private markets, and their investors were asking them for controls, and they couldn't understand why they needed controls. So they hired their first control expert from eBay, and they invited me to come and talk to them. But they were using Oracle. They asked me to come and talk to them about controls because I've written a book on, if those of you that don't know, on Oracle controls for Oracle. So I had the opportunity to meet them, and these people were, as Deepak said, they were fantastic engineers, right? They were some of the brightest people I've met from the top schools in the world, from academia, from just overall smartness, but they just couldn't understand why the controls would slow them down, is how they saw it, right? Controls slow you down. We're going at 1,000,000 miles an hour here, and if we break a few things, that's okay. That was the vision of their CEO at the time. So, so I had a hard time kind of convincing them that no, controls is how you run a business. If you can't control your business, you can't control your growth. And so that story, what that told me, I mean, that's one extreme example, but I think what I see is that they're different. So not all companies are the same. So there's some pre-IPO companies that are been in business for, for many decades. Aramco is an example of one of the world's largest IPO that happened out of Saudi Arabia. That company is more profitable than, I think, all the 3 or 4 top US tech companies put together, and they have excellent controls. So there are different ranges of companies, from just a very informal company that wants to on a fast path to go public, and then there's companies that are on just very mature companies that are just considering a change in their capitalization. They're going from private to public, and that often happens. I mean, there's a company again in Texas. You all probably heard of Dell Computers, Dell Technologies. They've gone private. They will go public at some point. So that's part of financial management that a board decides and companies go through many times. And so each company is different, but when I think generally about companies, why they need controls, and what I tell people that need to, I guess, learn from this, is that controls are basically how you run a good business, right? It's not something you should think about that I'll do this only if I have to go and list on a New York Stock Exchange or London Stock Exchange, right? Because they all require that. It's not a requirement. And us folks like Deepak and myself, one of the things we think about when we think about controls is the control environment. How do people behave in this company? What are the sort of what we call entity level control or company level control? As part of that, we also pay attention to the tone at the top. how do the leaders of these companies think about controls? Are they respectful of the controls? Do they believe in the controls? And clearly, in case of FTX, since we've been talking about that, the founder and the CEO did not, right? So if you have tone at the top that is not friendly towards a controlled environment, the people that work for that leadership follow what the company's culture is and what the leaders are doing, right? And if they're not following controls, they're not, simple things like turning expense reports. If the executives are getting away by turning, fudging their expense reports, chances are there's a problem in that company below as well. And somebody, they're not doing what's in the best interest of their stockholders. So controls is a startup is basically an informal process for startups that have not been running, that are a new company like FTX was, or the social media company I talked about. So what they need are folks like Deepak that can come in and give them a good education about risk management, about risk assessment, about linking controls to risk, and really setting up a framework. And there are many frameworks available out there. You don't have to follow COSO, which is a framework that most public companies follow. You can pick a simpler control framework. So COSO framework goes back to the 1970s again. So it's a very mature framework, and we like it for that reason. But there's also ISO 31000 that's popular in certain parts of the world. There's many others. So whatever your risk management framework is, folks like Deepak can come in with us and help you kind of get up to speed on it. And once you have that framework and you create that common knowledge, that lingo of how you speak about controls in the organization, then you can start thinking about maturing. Now, if you're already a mature company, and like I said, there are many mature companies that go public and go private and switch back and forth, and we see that especially in the economy that we're entering into next year. Everybody is pretty much declared it's going to be a recession. You will see a lot more M&A in that environment. You'll see more private companies, big hedge funds and private equities coming in, taking companies off the public market. The most obvious one in our recent history is the joke at Twitter, right? Elon Musk taking that private. So you'll see that happen. And so what people think is that, okay, now we've gone private or we're private, we don't have to comply with controls. But I think that's a short-sighted view. Certainly there's not that burden. I won't disagree with that, because you don't have to file the disclosure statements with the SEC. However, you still have to make sure your processes are effective, so the results you're producing, disclosing to the stockholders or investors. You still have investors, right? Any sizable company will have investors, even if it's employee-owned, right? So employees are the investors of that company. So you'll have investors in any sizable company. And if those investors are not getting the right picture of the business, they have the right to litigate. They have the right to demand management changes, model changes, even shut down the business in many cases, right, through bankruptcy, etc. So it's not a good thing to not have control. I think people generally understand that. I think the challenge is that when companies are private, the formality of the control goes down a bit. And that's why I recommend that, please maintain your framework, adopt a framework, whatever you think is right for your organization, and maintain that level of control over your business, because you still have investors, you still have employees, you still have customers, and they're all going to demand those controls. And if you're sleeping at the wheel and you're not paying attention, it also restricts your ability to raise more capital, right? Because one of the clauses you'll see in any investor is that, do you comply with these control standards, and what do your auditors do? When did they last audit you? So that's the kind of information we want to share. Now, if you are most companies, like I said at the beginning of the cast, is that many of them have good intentions. So if you do have good intention, you want to maintain good controls as a startup, as a pre-IPO company, that you should consider maintaining that level of testing of controls, and try to go from an informal approach, which is where you might be if you're a startup, to more of a maturity level. So we have the CMM level 5 maturity model for controls, where it goes, from informal controls all the way to optimized controls, right? Everything in between, proactive and so forth. So you can follow that path. I think it's on our website, and we can share more details with you where you are in the roadmap today and where you can be. So we help you baseline your controls, and that'll help you move forward to a level where you're investor ready, you're growth ready, you're ready for running your business well.
And what would your words of advice be, Deepak?
I think spot on, Adil. Just a couple of points. One is the way I tell a number of my clients is that think of controls as a brake in a Formula One car. The brake is not there to reduce the speed, it's to prevent the driver from going to, as fast as he can or she can. The idea is to safeguard it. The driver is able to go that fast only because he or she knows that there are brakes. So that is the job of internal controls. So we are not there as a bottleneck. And relating that to FTX, which was the starting of the conversation, if FTX would have had decent internal controls, they would have, even despite the currency fall or whatever, they would have still managed to salvage and sell on whatever there is to another company and exit or move away from it. But the utter lack of controls, the utter lack of management intent or tone at the top, as Adil was saying, is clear, and you can see what's happened. So that's the first point. The second point, in terms of companies getting ready for IPO, I think, again, these companies will most likely, if they're not in the crypto area at least, they will all be regulated, and there are regulations on what you need to disclose, how frequently, etc. There are lots of rules and regulations on how things have to be reported and in a certain way. And I know that it takes a considerable amount of preparation for companies to get their companies listed in stock market. And sometimes they have to restructure some of the management roles, responsibilities. They have to, and also put in new processes of management accounting, reporting, and audit in place, internal audit in place before they can get and set up a couple of mandatory committees as well, like audit committee, remuneration committee, etc. So there's a lot of preparation that is required, and all this preparation is essentially aimed at strengthening the internal control and to make sure that whatever results are being reported are standard, accurate, and reliable for the consumers or the shareholders. I think that's essentially the reason why companies at all levels need internal controls in their organizations.
Yeah, absolutely. And to finish off our discussion today, we've been talking a lot about controls. There are lots of different types of controls that exist, manual, automated controls. So, are there any solutions out there that can help organizations, automate the controls and be more efficient and succeed ultimately? Anyone?
Adil, do you want to take? Yeah, I'm happy to take that. I think
Sure.
most of the softwares have controls that can be embedded or which are preventive in nature. I think my personal view is that we need to get controls embedded so that they are seamless in the process, and that cuts out workarounds and future rework. And therefore, the attention is to embed as much as we can into the process, into the technology, so that life becomes easier. And then for those occasional ones where we can't have a preventive control or we need another pair of eyes, we then look at how we can get reports out of it. Those are all detective kind of controls, periodical reporting, etc., just to make sure things are consistent and to track anything that's out of the ordinary and to catch anything that's not working. So I think most organizations, most ERP solutions offer a range of these. But again, it's subject to how well it is customized and how well the client is prepared before getting this commissioned, basically, or designed.
Mm-hmm. Adil?
Yeah, just to kind of close on that thought that so Deepak, you laid out the importance of detective and preventive controls in ERP business systems like Oracle and SAP, et cetera, Dynamics. And I think that's a great way to look at controls, right? I would also encourage you to look at controls in terms of categories of controls. So there are business controls, which sort of fall into, how do you prevent risk from happening within a process, your procure to pay process, your requisition, your sourcing, etc., your order to cash process, etc., right? And then there are the controls that are what we call IT general controls, right? These are controls on how you control the systems that manage these processes today. So ITGCs are those controls. It could be at the network level, database, if you're doing cloud, it's infrastructure, application level, change management within the application. And there's another category, ITAC, which is the IT application controls, right? So if you think about controls in those categories and who owns what controls, some of these controls are pervasive, right? So we talked about that earlier. Deepak mentioned ITGCs, and so I wanted to just close by saying that. So once you decide which way you want to go, you want to select that, and set ownership, who owns what controls, and that can be tricky, right? So it's good to talk to some experts that have spent, decades, like Deepak has, helping companies do these kinds of controls, and they can guide you on where to best provide the responsibility, accountability for these controls. And then where SafePass comes in is really to take that mystery or confusion out of the controls alignment, that first question we started with. Basically, SafePass is a governance platform, so it governs the enterprise and all that risk and chaos that happens in an organization where, because of the misalignment, it basically steps in, does it for you. So it has the ability to design a policy, assess the risk against that policy, ensure the control is deployed to prevent risk in the process through an automated control. And if it's a manual control, it has capabilities. So that alignment stays there. So let's say your business changes, you open up a new business office in a new region, let's say in China or whatever, or you acquire a company, or you put a new system in. So you're using Oracle, you move to SAP, or you have personnel reorganized for hybrid workforce. All of those things that happen, your organization can remain agile, whereas SafePass will protect your organization, safeguard your organization with the controls that will always be there to monitor you, right? So whether the ERP control is turned off or on, we will catch that. Great example is a three-way match. If you turn on three-way match, that's a control. So your purchase orders, your invoices, and your receipts match up. But there's also possibility someone may turn it off and you don't catch it. So now you have controls, but again, as I mentioned at the beginning, ERPs are not designed to govern over their processes. So that's where SafePass comes in. It governs all of these controls, and management risk is mitigated and prevented from happening.
Well, we've had a great discussion today. I will turn back on my camera. I was having network issues. So there we are. So a huge thank you to Deepak for joining us today, and a big thank you to you, Adil, and to everybody who's taken the time out of their busy schedules to join us today. We hope the session provided some great insight, and if you do wish for a further discussion, then don't hesitate to reach out to either to either myself or Deepak or Adil, and we can have that discussion with you. So yeah, thanks everyone for joining, and happy holidays.
Happy holidays.
Thank you all. Happy holidays.
Thank you.
Bye.